Hello financial fans, welcome back to another stock analysis. Today we'll be covering Lululemon, stock ticker LULU. Lululemon is a leading athletic apparel company known for its premium yoga and activewear offerings for both men and women. Founded in 1998, the brand has gained immense popularity for its emphasis on blending fashion with functionality. Lululemon's products are crafted using innovative fabrics and designs, ensuring comfort, flexibility, and performance during various physical activities. With a wide range of stylish leggings, tops, shorts, and accessories, the company has built a loyal following of fitness enthusiasts, yoga practitioners, and athleisure enthusiasts around the world. Beyond selling clothing, Lululemon also fosters a sense of community by hosting events, fitness classes, and workshops, promoting an active and healthy lifestyle among its customers. The company is currently sitting at a market cap of $50 billion, and in 2022, they generated a revenue of $8.1 billion. 45% of their revenue was generated through company-operated stores, 46% through direct-to-customer, and the remaining 9% from various other income streams. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 20% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from margin of safety. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $392 million in 2013 to $1.7 billion in 2022. The EBIT growth during this period on average was 20%, which is a 10% deduction of a margin of safety. The margin has gone down over the years, going from 24.6% in 2013 to 21.3% in 2022. The average margin decline is only 0.8%, which is no change in the margin of safety. The final two ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Lululemon, this is 0%. As you can see on the top left, their cash position is much bigger than their debt position, meaning they have no net debt, which indicates a 0% debt to EBITDA ratio, which rewards them with a 5% deduction and a margin of safety. The return on invested capital for Lululemon is sitting at a very nice 31%, indicating that the management is very effective at allocating capital, which awards them with yet another 5% deduction and a margin of safety. Looking very good so far for Lululemon. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model we'll be using is the discounted cash flow model. I've imported the free cash flow of Lululemon going from 2015 to 2022. The average growth rate in the free cash flow annually during this period was 25.4%, and I'm projecting an expected growth rate in their future free cash flow of 20% annually for the next 10 years. This because they saw a vast dip in their free cash flow in 2022, I think they can rebound significantly. With this 20%, we can determine the future free cash flow for Lululemon and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 9%. This gives us a sum of free cash flow of $17.1 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, giving an equity value of $27.2 billion. Dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $223.26, which is a 41.31% downside out of this model. The second model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that Lululemon is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company with no growth should never exceed 7. Looking at all of these metrics, we get a fair value sitting at exactly $180, which is a 52.68% downside of this model. The next model that we'll be using is the multiple valuation. In this model, we look at similar companies to Lululemon, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 54.87. All stuff to do then to get our fair value is to multiply it by the earnings per share that Lululemon is generating, which is $7.50 a share, giving us a fair value of $411.50, which is a 8.70% upside from the current price. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metric that we use to determine this is the PE ratio. I've imported the PE ratio of the past 5 years, and on average it has been sitting at 58.24, while the current PE ratio is sitting at 50.72, indicating that it's currently undervalued on this metric. This gives us a fair value of $436.80, which is almost a 50% upside from the current price. If you want to get access to all of the models that I use in my videos and much more, you check in the description for my Patreon link. Anyways, getting the self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at our final overview, we've imported the discounted cash flow, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $312.89. A margin of safety we've determined earlier using a standard margin of safety of 20%, deducting it by 5% for debt to EBITDA, 10% for the EBIT growth, and 5% for return on invested capital, leaving us with no margin of safety at all. This means that the fair value is the same as the average out of all of our models. And with a current price of $380.41, we get a downside of 17.75%, indicating that it's currently a sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.